This is a demonstration of the comprehensive tax allocation problem for Chapter 19. I'm going to split this demonstration into two videos, one for the first year, 2019, and then I'll do a second video for 2020 so it doesn't get quite so long. The purpose of this problem is to give you a better idea of how we determine our deferred tax assets and liabilities and our deferred tax expense or benefit for the year when we have permanent differences and temporary differences and how those change over time. So it's a much more involved problem, but it gives you a much better idea of how this actually works. So one thing that is important when we're dealing with originating and reversing differences for deferred taxes is that we have a schedule of these. So what we will be doing in the problem is we will be working in 2019 to show the differences between pre-tax financial income and taxable income, but we'll also be scheduling out the reversing amounts in the future and determining how those tax effects will occur and what the totals will be for both the balance sheet and the income statement. So whenever we do this schedule, we start out with whatever we have on our financial statements for pre-tax financial income. So let's go down to the bottom and just look at what the problem told us. At the very end, it tells us that pre-tax financial income for 2019 was $412,000. It gives us the enacted tax rates at the end of 2019. This year, the tax rate was 30%, but in future years, starting in 2020, it will decrease to 20%. So they tell us this is a calendar year accounting period, and also they expect to have taxable income in future years. Two other things that we need to note down here is this company has some permanent differences. So non-taxable municipal bond interest revenue was $28,000. So we know that that revenue would not be taxable on the tax return. And they had non-deductible fines and penalties of $26,000, and we know those aren't deductible on the tax return. So we're going to deal with these permanent differences first because they won't reverse. So let's go back up to our schedule now. We start with pre-tax financial income. So it's always important to get in your mind that everything that we are going to be adjusting is already included in this amount. So you have to think of it, we're going to be taking those amounts out. So for the municipal bond interest, it would have been included in $412,000, so it's going to need to be subtracted to get to taxable income. The fines and penalties were also included in this amount, and they were a deduction, so we're going to have to add those back. So just kind of get that process in your mind. Now, I've included a subtotal for mine. You wouldn't necessarily have to have that subtotal, but I just like to throw it in there because it's the amount that we could actually calculate the effective tax rate, because remember, permanent differences change the effective tax rate of the company. Now that gets us through the permanent differences, but now we're going to have to deal with the temporary differences. So remember, there's always going to be an originating temporary difference and then a reversing amount. So in the schedule, in this column, we're going to have the originating differences, and then we're going to schedule out the reversing amounts in the future years. So let's start out and read what the problem tells us, and then we'll go through each of those temporary differences. So this company had 7 contracts that allowed their customers to pay on an installment basis. They recognized $560,000 of gross profit for financial reporting purposes, but only reported $112,000 of gross profit on installment sales on their tax return. And the company expects the future collections on the related installment receivables to result in taxable income of $112,000 in each of the next 4 years. Okay, so let's talk about this. This is revenue that we would have recorded and included in pre-tax financial income based on accrual basis accounting. So we satisfied our performance obligations, so we debit accounts receivable and we credit sales. However, for tax purposes, we only collected $112,000, so that is the amount that we would actually report on the tax return. So what we're going to be dealing with is this difference, the excess revenue that we reported on our books, but we cannot include in the tax return. So that would be a subtraction because we included the $448,000 to get to pre-tax financial income, and it would not be included on the tax return. Now that will be, we expect to collect that amount evenly over the next 4 years, so those are going to be reversed in those years. Now we know that when we subtract an amount of revenue from financial income, we're going to eventually, that's going to show up on the tax return. So that $448,000 times the future tax rate is going to result in a deferred tax liability of $89,600. Okay, because we will owe more taxes in the future when that income is reported. Okay, the next part of the problem deals with depreciation. It says that Almond purchased depreciable assets with a cost of $540,000. So for financial reporting purposes, they depreciate their assets using straight line over a 6-year service life. However, for tax purposes, the assets fall into a 5-year recovery class and they use makers. And we talked about this when we went through the chapter, that most of the time there will be a book to tax difference for depreciation because you cannot use makers for financial reporting purposes. It is an accelerated method of depreciation, and of course we know straight line is not accelerated. So for straight line purposes and book purposes, we're going to report the same amount of depreciation, $90,000, over each of the next 6 years. That's $540,000 divided by 6. Now, the tax return is going to use makers, and these are the amounts that they give us for each of the next 6 years. And we notice, of course, it being accelerated, the amounts are more than straight line in the earlier years, and then it will be less in the future years. So they give us those amounts, and we can get the difference. So these are going to be the amounts that the tax return will be different from the financial statements, and the amounts that we will have to adjust for over the life of these assets. So we schedule those out, or we can look at first this year. Again, depreciation per books is $90,000. That's the amount that was subtracted to get to pre-tax financial income. But for the tax return, it should have been $108,000. So we're going to subtract an additional $18,000 to get to taxable income. We're going to schedule out these differences that they gave us for each of these years. And when we net all of these, we get the $18,000 that we subtracted, additional depreciation on our tax return, and that will create a deferred tax liability when we multiply it by the future tax rate of $3,600. Okay, the last item that's a temporary difference is going to be warranty expense. So this tells us in the problem the company does give a 2-year warranty on all of the at the completion of their contracts. So the amount for 2019 that was recorded as warranty expense per books and recorded as a liability would have been the $200,000. That's based on accrual basis accounting that requires us to record an expense and a liability for our assurance type warranties. However, for tax purposes, we only paid out $44,000 in repairs. So for tax purposes, we only can deduct the amount that we actually paid in expenses. So what we're going to be dealing with then is this difference, additional expense that was recorded on our books that we cannot deduct on the tax return. And the problem tells us that we expect to actually pay those repairs at $56,000 in 2020 and $100,000 in 2021. So let's look at our schedule. For the warranty expense, that's going to be added back because all the warranty expense, the whole $200,000, would have been deducted to get to pre-tax financial income. We only spent $44,000, so we have to add back the difference. Then in the future, we will be able to take those deductions as we actually make those repairs. So this is going to result in a future deductible amount of $156,000, which when we multiply it by the tax rate will give us a deferred tax asset of $31,200 for 2019. So I'm first going to talk to you about what is going to be the balance sheet presentation for deferred taxes. Remember in the chapter we discussed that we net our deferred tax liabilities and our deferred tax assets, and we report a net amount non-current. So our deferred tax liabilities totaled to $93,200, and when we subtract the deferred tax asset of $31,200, we get a net non-current liability of $62,000 for our balance sheet. Now, finishing out our schedule, we get taxable income when we make these adjustments from pre-tax financial income of $100,000. This year the tax rate is 30%. So our tax return should show that we owe the IRS $30,000. Okay, so that will be income tax payable. We also notice on our schedule that we can add up or sum the amounts for each of the years, multiply those by the future tax rate, and we get an amount that we expect to be the reversing amounts over the next 5 years. That's as far out as our schedule goes. When we add all those amounts together, notice we get the same $62,000 that we calculated for the balance sheet. Now, when we determine the amount of income tax expense for the year, remember there are two components. There is the current component, which is actually the amount that we are showing that we owe on the tax return. Then we have to calculate what the deferred component will be. Now this year, this company did not have any deferred tax assets or liabilities at the beginning of the year. So when we take the deferred tax asset at the end of the year, we're going to have the same amount for our income statement. Same thing for the deferred tax liability. Since we didn't have anything at the beginning of the year, the deferred tax expense for the liabilities is going to be the same amount for the end. We netted those two and we get the $62,000 for the deferred portion of income tax expense for 2019. So adding that deferred component with the current tax expense or income tax payable on the tax return gives us income tax expense for 2019 that we'll use for our journal entry. When we present income tax expense on the income statement, we need to break out the current and the deferred portion. It should either be on the face of the income statement or more than likely it will be in the notes. And we will only probably show the $92,000 as the provision. To make the journal entry for 2019, we're going to record or debit income tax expense for $92,000. We're going to debit our deferred tax asset for $31,200, and we're going to credit the deferred tax liability for $93,200 and credit income tax payable for $30,000. So that will complete the demonstration of the comprehensive tax allocation problem for 2019, and I'm going to do a separate video for the next year, 2020, which will carry over this same information that we did this year, but also add in new originating and reversing entries. So come back and watch the second part, and that is the end of the presentation for the first part of the comprehensive tax allocation problem.